If you own a balanced portfolio, something like 60% stocks, 40% bonds, you were probably told it would protect you when markets get ugly. And for a long time, that story felt true. Then came 2022. Stocks fell. Bonds fell. And millions of everyday investors discovered something Wall Street rarely says out loud. Diversification is not a force field. It is a bet on how different assets move together. And in a true stress test, that bet can fail. In the next 8 minutes, we are not going to tell you to panic, dump index funds, or buy exotic hedge products. We will walk through 3 real crises, 2008, 2020, and 2022, and show when diversification bent, when it broke, and what you can do as a regular investor. Educational content only, not financial advice. Modern portfolio theory, simplified. Combine assets that do not move in lockstep. When stocks fall, bonds are supposed to rise, or fall less. That is the logic behind the classic 60-40. For roughly 2 decades, stocks and bonds often moved opposite. But a 60-40 portfolio is not half safe. Research shows equities can drive roughly 90% of total portfolio risk, even at 60% of the money. You are mostly writing stocks with a bond cushion. The cushion matters. It is not a separate engine. 2008. The S&P 500 fell about 37%. A 60-40 portfolio fell roughly 20%. Painful, but better than all stocks. Treasuries rallied, but correlations spiked. Stocks that moved independently started moving together. Average equity correlations jumped from around 0.4 to near 0.7. Almost everything fell at once. Bonds helped at the portfolio level. Inside the stock sleeve, diversification offered less protection than your fund prospectus implied. March 2020. COVID crashed markets at record speed. For weeks, even treasuries wobbled in a liquidity shock. But the pattern mostly held. Stocks collapsed. Quality bonds recovered. The Fed cut to zero. By year-end, many 60-40 investors were positive again. Lesson: in a deflationary panic, the stock-bond hedge can still work. Your portfolio bends. It does not always break. 2022 was the plot twist a generation had never seen. Inflation surged. The Fed hiked fast. The S&P fell about 18%. The broad bond aggregate fell about 13%. Stocks and bonds lost money together. The 60-40 dropped roughly 17 to 20%, one of its worst years on record. Simultaneous negative years are rare, about 8% of years since the 1870s. But when they hit, balanced portfolios feel anything but balanced. The hedge stopped working because the enemy was not recession panic. It was inflation. Correlation, plain English. A score for how 2 investments move together. +1 means lockstep. -1 means opposite. Near zero means mostly independent. In calm markets, diversification feels free. In crises, correlations rise toward +1. That is correlation breakdown. The stock-bond relationship is not permanent. For 23 years, negative correlation felt normal. But over longer history, positive correlation has been more common. Inflation above roughly 2.5% has pushed stocks and bonds toward moving together. Diversification did not die. The regime changed. What to do without Wall Street jargon? First, know what you own. A 60-40 fund is still largely a stock bet. Size exposure to drawdowns you can tolerate. Second, keep a cash buffer for 1 to 3 years of expenses. Third, no bond duration. Long bonds got hit hardest in 2022. Fourth, consider tips when inflation is the risk. Fifth, diversify beyond one country. Finally, rebalance on a schedule. None of this guarantees profits. It beats believing diversification is magic. Diversification is real, but it is not armor. It depends on which crisis arrives and how assets correlate when fear takes over. The 60-40 is not dead. Pretending it cannot hurt you is the dangerous lie. Subscribe to Money Made Simple, new explainers every Tuesday and Friday. Watch our retirement math series next. Stay curious, stay diversified, with your eyes open.